Welcome back, everybody. Today we're going to talk about loans. As a startup, you need money to grow, so most of you need funding. The three most common ways to get funding are the following. You can get a loan, you can sell your shares for cash, or you can use convertibles. Today's film is about the first one, loans. Loans are easy, right? At least the concept of a loan is easy. Let's look at an example. Party A, a lender, let's say a bank, loans the money to Party B, let's say a startup. Let's make this your startup, and let's call this startup JADAP. Usually the lender lends the money in exchange for a compensation. The compensation, in general, is a percentage interest over the total amount. So in this example, if the bank lends $200K to your startup for 4% interest, then after 1 year, you have to give back $200K, the initial amount, plus $8K, which is the interest. So the bank gets compensated for the risk in lending you the money. In general, it is very difficult to get a loan as a startup. Why? Well, basically, most startups fail. Let's suppose 1 out of every 5 startups fail. So a bank lends an equal amount to 5 different startups. Then how much interest percentage must a bank receive in order to break even on their activities? So no profit, just break even. From the bank's perspective, they should receive at least 25% interest to break even on their lending activities to startups, or else they lose money. This is because the other 4 existing startups should compensate for the loss of 1. Now from your perspective, you as a startup want a loan against 25% interest? I don't think so. And actually, the startup fail ratio is something like 7 out of 10, or even 9 out of 10. So this example is still on the conservative side. In general, this is not a realistic business case for a bank. I suppose you could say, but the bank can get some collateral to make up for the gap. When you buy a house and get a mortgage, then the bank will loan you the money with the house as collateral. But what is the collateral in an early-stage startup? Some second-hand Apple computers and a wall with Post-its? Overall, if the startup fails, then the bank has nothing to recover. There are a few exceptions, though, like patents, but this is the general rule. So in the end, this is why loans are so uncommon for early-stage startup funding. Luckily, there are other funding options for startups. Jump onto our other movies about convertibles or shares to learn more. For now, hope you've enjoyed it, and leap on to our next movie to fund your brain with new knowledge.